The company that once made canvas shoes for Vietnamese soldiers is betting everything on a luxury apartment boom that might already be over. Thuong Dinh Footwear just got shareholder approval to tear down its factory in central Hanoi and build a 40-story residential complex worth nearly 10 trillion dong, about $400 million. The catch? Investors are already dumping apartments across Vietnam to cut their losses. Thuong Dinh was founded in 1957 as a military workshop, producing footwear for North Vietnamese troops. For decades it was a household name in northern Vietnam, exporting canvas shoes across the communist bloc. Now it's a struggling state-owned relic being privatized at the worst possible moment. Hanoi sold its entire 68.67% stake in November 2025 for less than $5 million. The new owners immediately pivoted to real estate. Here's the mechanism driving this. Hanoi is forcing factories out of the urban core as part of a massive restructuring plan to relocate over 860,000 residents by 2045. Thuong Dinh sits on 3.6 hectares, about 9 acres, at 277 Nguyen Tre Street, prime land in Thanh Chien District. The company will relocate its manufacturing to Dong Van Industrial Park in Ninh Binh Province by August 2026. What's left behind gets redeveloped into towers between 25 and 40 stories, mixing apartments with office and retail space. Construction giant Vinaconex just bought a 48% stake to lead the project. But the timing is brutal. After years of soaring prices, Vietnam's apartment market hit a wall in early 2026. Hanoi and Ho Chi Minh City both saw speculative buyers start selling to cut losses in February, according to local real estate analysts. The government is now drafting anti-speculation tax policies because prices climbed so high that ordinary families were priced out entirely. Property prices in Hanoi would need to drop significantly just to reach what experts call reasonable levels. One analyst told state media the market needs sustained declines before affordability returns. This isn't an isolated gamble. It's part of a pattern across Vietnam where old state factories on valuable urban land are being converted to residential towers. The broader question is whether these projects are being greenlit based on 2023 price assumptions in a 2026 market that's already cooling. Thuong Dinh's new owners are committing hundreds of millions of dollars to a development that will take years to complete, in a city where apartment prices are already under pressure and the government is actively trying to cool speculation. The real risk isn't just one failed project. It's that an entire wave of factory-to-residential conversions across Hanoi could flood the market with high-end units at exactly the moment demand is softening. Thuong Dinh will move its workers to Ninh Binh and break ground on luxury towers by late 2026. Whether anyone will want to buy them by the time they're finished is a question the shareholders apparently didn't ask.